Welcome to Talk Tickers. We're jumping straight into Boyd Gaming's Q3 2025 earnings call today. That's ticker BYD.
Yeah, and our goal here is really to break down what management said, look at the numbers, and figure out, what's driving growth and what challenges they're facing.
Okay.
And there's this interesting split this quarter, isn't there? You've got really strong core performance, but then some specific weakness in their destination business.
Right. That's the main story. So let's start high level. Give us the snapshot for Q3. What did the top line look like?
Well, the numbers were pretty solid. Revenues once again cleared $1 billion, so still a huge operation.
Okay, $1 billion plus.
Yeah. And adjusted EBITDA was $322 million for the quarter. Now, that's after factoring in the FanDuel transaction impact.
Good. And margins.
Margins held up really well.
Yeah.
Company-wide operating margins were basically flat with last year, came in strong at 37%.
37%.
Yeah.
So steady margins, decent cash flow generation at $322 million. But like you said, the narrative management pushed was how they got there.
Offsetting weakness. Exactly. It's all about the customer mix. They kept highlighting the continued growth they're seeing from their core customer base, and importantly, also from their retail customers.
Okay, let's unpack core and retail.
Yeah.
What specifics did they give? How do we know that demand is actually healthy there? Needs to be more than just saying it's up.
Fair point. For the core customers, the established ones, they described it as a stable, long-term growth trend. But the really encouraging part, I think, was the retail segment. That's your sort of lower-end rated players and the unrated ones.
Mm-hmm.
And management said they saw improvements across the board. There are people visiting more often and spending more when they do visit. That suggests it's pretty broad-based strength in their main markets.
Okay, so if the core is healthy, let's zero in on the big one. Las Vegas locals, always a key segment. How did it do, and was it straightforward?
Well, the headline numbers for locals were $211 million in revenue, $92 million in EBITDA, and the margin was impressive, 47% industry-leading stuff.
47% margin, wow. But you hinted, was there a catch?
There was. Those headline results were actually dragged down quite a bit by one specific property, the Orleans.
Ah, okay. So if we pull the Orleans out, what does the real underlying locals performance look like?
Management gave that number specifically. Excluding the Orleans, the rest of that segment actually grew revenue and EBITDA by 2% year over year.
2% growth.
2%, which sounds maybe modest, but in the context of that large base, is pretty solid. And they tied this to the local economy, didn't they?
They did, yeah. They pointed to Southern Nevada's resilience, things like wage growth being up over 6% in the last year.
2% wage growth, okay.
And also economic diversification. It's not just tourism anymore. You're seeing growth in education, health services, transportation, business services. That all feeds into disposable income for their local customers.
Right, more people working, higher wages. Did they mention anything else boosting local wallets? Maybe on the policy side? Uh-huh. They touched on the recent tax bill, things like deductions for tips and overtime, a specific deduction for seniors, and the larger standard deduction overall. The thinking is, all that puts a bit more cash in their customers' pocket.
Makes sense. Okay, let's shift gears away from Vegas. What about the Midwest and South segment? Big portfolio there.
Yeah, that segment had a really strong quarter. In fact, it was its best third quarter performance for revenue and EBITDA in 3 years.
3 years, okay. What were the numbers?
Revenue is $539 million and EBITDA $22 million. And the key thing here was that they said the growth was broad-based, pretty much across all 17 properties in that group.
17 properties all pulling in the same direction. That's a good sign. Any particular standouts?
They did call out Treasure Chest again. That's the property in Louisiana. It's still showing growth more than a year after they opened the new land-based facility there. Shows good execution on that project.
Good point. Execution matters. Okay, so Midwest and South strong. Underlying, local strong if you exclude Orleans. Now we have to talk about the weakness. Where were those destination headwinds concentrated?
Mostly two spots. First, as we just discussed, the Orleans. That was the main reason the overall Vegas segment EBITDA was down.
Okay, Orleans was number one. What else?
The other area was downtown Las Vegas. That segment ended up basically flat compared to last year.
Flat in downtown, why? Usually that benefits from specific travel, like from Hawaii.
Well, that's the interesting part. They actually saw growth from their Hawaiian customers, which is a key group for them downtown.
Okay.
But that growth was completely offset by softness in the sort of broader destination business. That showed up as lower hotel revenues and also apparently less foot traffic down on Fremont Street during the quarter.
So maybe convention business or general tourism to that specific area was still a bit weak. What's the outlook there? Are bookings picking up?
Management said it's improving, but still cautious. The forward 90-day hotel bookings look better than they did, but they're still, soft compared to what they normally see historically. Trend is up, but from a lower base.
Okay, paints a clear picture. They're managing the local side well, navigating some temporary bumps in destination travel.
Which naturally leads us to capital allocation. A company generating this kind of cash flow, where are they putting it? Let's talk CapEx.
Right. Big numbers here. They're now expecting $600 million in total CapEx for the full year. That's a lot of spending. What are the key growth projects and what kind of returns are they aiming for?
Yeah, $600 million is significant. And they have a very high bar for returns on new growth projects, 15 to 20% cash on cash. That's quite disciplined.
15 to 20% hurdle rate. Okay, what are the big projects driving that spend?
Well, the biggest is definitely the new Virginia resort. That's a $750 million development. And the transitional sort of temporary casino there is set to open in just weeks.
Weeks away. So that starts generating cash soon.
Exactly. And then the full permanent resort is scheduled for November 2027. That's a huge potential needle mover down the line.
Okay, Virginia's the big one. What about closer to home in Vegas?
They're building Cadence Crossing. That's a new property aimed squarely at the Las Vegas locals market. Construction's underway, opening planned for Q2 2026. Reinforces that focus on the local customer.
And they also manage travel casinos, right? Sky River?
Yep, Sky River. Demand there is apparently still very strong. They're expanding it in phases. Phase 1 is 400 more slots and a parking garage finishing up early next year, Q1 2026.
And phase 2?
Phase 2 is bigger. A hotel, more food and beverage, a spa. That's targeted for mid-2027.
So lots of growth CapEx. But $600 million also means they must be doing significant renovations on existing properties, right? Which can be disruptive?
Absolutely. And they are. Suncoast is getting a major overhaul casino floor, meeting spaces, public areas, the works. Management actually noted that even with all the construction disruption, Suncoast performance is holding steady year over year.
That's impressive. Managing to the disruption. When's that done?
Expected completion is mid-2026 for Suncoast.
What about the Orleans? The property that was dragging down the locals' numbers. Are they fixing that up too?
They are. That's next on the list. The room renovation project there starts next month, Q4, and then a bigger transformation is planned for the Orleans after Suncoast is mostly finished, likely to manage the operational impact.
Makes sense. Okay, all the spending points to confidence. But maybe the biggest story this quarter wasn't operations or CapEx, but the balance sheet. That FanDuel stake sale, huge impact.
Oh, absolutely game-changing for their financial profile. Selling that stake allowed them to pay down a ton of debt. The total leverage ratio just plummeted, went from 2.8 times down to 1.5 times.
1.5 times? That's incredibly low for a casino operator.
It really is. Even if you look at lease-adjusted leverage, that dropped significantly too, from 3.2 times down to 2.0 times.
So with leverage that low, what are they doing with all that financial flexibility, that excess capacity?
Returning capital aggressively. They bought back $160 million worth of their stock just in Q3.
$160 million in one quarter.
Yep. And they explicitly say they plan to keep buying back shares at a pace of $150 million per quarter, plus paying the dividend.
So $150 million a quarter consistently. Has that made a dent yet?
Huge dent. Share count is down 11% year over year. And if you go back to late 2021, it's down 30%. 30% reduction.
Wow. But is 1.5x leverage the new normal? Or do they plan to creep back up? What's the target?
They said their long-term optimal target is actually around 2.5 times leverage. So they're comfortable being low right now, but that gap between 1.5x and 2.5x, that's a lot of dry powder, potentially for more returns or maybe M&A down the road.
Right. Speaking of other areas, what about their online segment? Any updates there, especially after the FanDuel deal and M&A?
Yeah, the online segment seems to be doing well. They actually raised guidance for it. And they announced a new partnership, too, with Fanatics. They'll be running the sports books for Fanatics in Missouri at Ameristar, Kansas City, and St. Charles. Operations start December 1st.
Okay, getting into Missouri sports betting and M&A. Are they getting acquisitive with that strong balance sheet?
Management sounds like they're sticking to their usual disciplined approach. Watching for the, quote, right asset in the right market at the right price. Given that high 15-20% return hurdle for CapEx, you can bet they won't overpay for acquisitions either.
Sticking to their knitting. Okay, before we get to our last segment, quick check on the quarter's flow. Were these trends pretty steady July through September?
Yeah, they indicated the core trends were fairly consistent throughout Q3, and that underlying strength carried right into October as well.
And the disruption from renovations like at Suncoast, could they put a number on the impact?
They basically said it's hard to quantify exactly, but the focus is managing it effectively, and the fact that performance is holding up year over year suggests they're doing a decent job of it.
All right, that covers the core results and outlook. Let's shift gears now to our final segment. This is where we do the not financial advice pitch and outrageous but maybe plausible trade idea based on what we just heard.
Okay. And given everything we've discussed, it has to revolve around that balance sheet, right? The super low leverage and the stated target.
Exactly. That gap between 1.5x and 2.5x leverage. How could you play that? Lay out the trade.
All right, here's the pitch. I call it the leverage recapitalization bet. They've got, what, $650 million, maybe more, in debt capacity before they even hit their own 2.5x target.
Okay, $650 million plus in capacity.
So the idea is, Boyd should immediately launch an accelerated share repurchase. Forget the steady $150 million a quarter for a moment. Use that debt capacity, lever back up towards 2.5x, and fund a massive, say, $500 million plus buyback on top of the regular pace. Do it quickly.
Wow, okay. A huge debt-fueled buyback acceleration. What signal does that send? Why do it?
It signals massive confidence. Confidence in their underlying cash flow. Confidence that those big CapEx projects like Virginia are going to pay off handsomely. A buyback that big, funded by debt, instantly juices EPS. It tells the market loud and clear, our stock is undervalued and we're putting our money where our mouth is, using this pristine balance sheet to reward shareholders now.
That's definitely bold. Using the balance sheet strength not just as a safety net, but as an offensive weapon to immediately boost shareholder value.
Precisely. Monetize that deleveraging right away.
Okay, interesting idea. So, to wrap up our deep dive today, Boyd Gaming seems to be executing a really disciplined strategy. They're focused on that resilient local customer, managing through the destination softness, and building these big growth projects in Virginia and Vegas.
And doing it all with arguably the strongest balance sheet in their history. The discipline stands out the solid core results, that high hurdle rate for spending, and this clear commitment to returning capital.
So the final thought we want to leave you, the listener, with is this. Given that incredibly strong balance sheet and management's high 15 to 20% return requirement for new projects, how quickly can these big investments, especially that massive Virginia resort, actually start to meaningfully move the needle for a company that's now so significantly delevered?
Something to chew on.
Indeed. Thanks for joining us for this detailed look into Boyd Gaming's quarter. We appreciate you diving deep with us.